the thing that you want to achieve in life is always one step beyond the fear and the challenge that you face today. And just having the support and the love of the people that like believed in us and were behind the product and like love the why of what we're doing were the ones that helped get us through those tough times. And now looking back, it's 6 months later, we were at 20 million in May, and now we're at 120 million in October. And it was that support that really makes all the difference. So to all the entrepreneurs out there that want to build something, my message is now is the best time in history to try and do something on your own because of all the tools, the power of AI, and sort of the capital requirements are shrinking to build things. Build it.
And that is exactly what Si Katara did. He went out and started TappAlpha. He released his first ever ETF, which is TSPY, a little over a year ago. And he's followed it up now with ETF number 2, which is TDAQ, TDAQ, based upon the NASDAQ 100. So today we're going to talk to him about his latest ETF and his decision to use 0 DTE options in his products over longer dated options, why he looks at that as an advantage, especially during weeks like this, where you've got this guy popping up talking about rate cuts. And then after the closing bell, you've got Microsoft, Alphabet, Meta all reporting earnings. So let's hear his thoughts. If that is what you're looking for, please stick around. Boop. So, Sai, welcome back. Thanks for joining me, and congrats on TSPY. So I think the first time I did a review of TSPY, it was at $7 million of AUM. And now, fast forward to today, we're at $118 million of AUM, according to Seeking Alpha. So you've really seen a lot of great progress over the last 2-3 months, especially. So picking up that AUM looks great. So are you pleased with where you sit right now with TSPY?
Our little baby's growing up. It's so fun to sort of watch the momentum take off, and it's been an unbelievable process from lessons learned, hard days, great days, and just seeing, most importantly, like the retail do-it-yourself investors and how educated they are, how interested they are to learn what's under the hood. That was the thing I didn't realize, that there was such a groundswell of support for products in the market, and finding your people and what it would actually help support from a goal perspective is like the most important thing, because we're not super high yield chasing, really high flying flashy yield. We're like core, we want to make sure the nest egg grows but have income to deal with things that you need in today's life. And so it's, you know my story, where that was the thing. I've got a long time horizon, but I needed income today to sort of make ends meet. And that's the product we built. And we found people in the marketplace that can sort of align with that. And that's been the most rewarding thing, to hear how we're actually making an impact on people's lives. Like that's the juice. That's the stuff that keeps us energized to want to keep going through all the challenges that can come from launching a publicly traded product.
So now, one of the reasons you're on today is to talk about your new product, which is number 2 ETF TDAQ, TDAQ. This is based on the NASDAQ 100 with an option overlay again. So can you walk us through this product?
Yeah, so this is where the engineer in me gets excited, because we sort of love to solve like a big problem once and then try and scale it out to multiple different use cases. TDAC is exactly that. It is the exact same technology foundation, the same strategy, and the same execution as TSPY. But the only difference is you're swapping out the S&P 500 through SPY, and you're plugging in the NASDAQ 100 through the Qs. And so all of the same patterns still hold that the technology can identify and help you execute on. The main difference is that the volatility, implied volatility of the Qs is higher. And so you sort of see that benefit come through, where when IV is higher, there's more option premiums to potentially collect. And so you've got more headroom, or more juice, I call it, to be able to harvest every day. And so that's where you see the distributions are a little bit different now with the TDAC product that we have. It's a little higher because of that characteristic, but all the other patterns hold. And the coolest thing is everything that we learned in launching TSPY, we've codified in the fintech underneath it. And all of that on day one has been applied to TDAC. And you can see through the performance that it's doing what it was designed to do in collecting all of the upside of the NASDAQ 100 and harvesting little bits of option premium on top. So it's been a great start. And we were talking before we started the recorded conversation. The ability to launch our first fund, it was hard because you're learning a lot, and you're trying to figure out who the right partners are that can do this thing that no other institutions have really done with zero DTE, using physical shares inside of an ETF. But the second product was a breeze because we'd already been through that wall once. We knew what the patterns were, and so we could just basically plug and play, use the same network of partners, and then hit the button and hit go, and we were able to launch in a a much more efficient manner. And that's what I love to see, is that the same strategy, same tools, same process can be applied to many, many different things. And that's where the scale comes out moving forward. So that's exactly what TDAQ is. Owns the queues, daily, out of the money, covered calls to harvest little bits of option premium. We add it up, we distribute it monthly. And the other thing too that has been really satisfying for us is the feedback we get from investors and advisors. And so one of the investors that was an investor in TSPY was like, hey, if you're going to do monthlies on TDAQ, can you do it the third week of the month instead of the first week? And then if I own both, I'll basically get a paycheck every 2 weeks. And I was like, that's a great idea. So that's what we did. And you see TDAX distributions are now the third week of every month, and TSPYs are the first. So it's been unbelievable education, but so much fun to see this thing that was literally scribbles on a piece of paper when we first started this thing now take shape in two products that are launched, and we're continuing to scale. So it's been a lot of fun, and couldn't do it without folks like you that are educating on what's under the hood in products like TSPY and TDAQ.
As far as distribution rates for TDAQ, do you expect them to be a little bit higher, and do you expect the same, ROC and tax benefits?
So we're trading NDX. Technically, the ticker symbol is NDXP. It's the PM settled one. So same potential tax treatment as the one we use for TSPY. So it's 60-40, 60% long-term, 40% short-term. The distribution rate, we just did our first distribution last week, and we landed at about 17% annualized distribution, whereas TSPY has been about 14%. So you can kind of see the difference in the implied volatility reflected in the distribution rate that we're able to support.
You've talked about return of capital, and your thoughts on growth within a fund. So I imagine that you will scale that back as needed if we run into a market that's not so favorable.
Yeah, and it's a judgment call on what you prioritize. Do you prioritize the distribution rate, or if the market goes down where the returns don't support it, do you prioritize retaining NAV? And it's hard. Like I think in the long term we prioritize retaining NAV, but markets are cyclical, right? So if you look back at April, there was a huge drawdown, but then it came back pretty quickly. And so we were able to sort of retain our consistent distribution level. And then over time, the NAV was able to sort of keep up. So, we've got some rules in place that say, okay, if it's a sustained drawdown or we're not able to fill the hole with option premium, then we have to reconsider what we're able to distribute. But it's really important for us to maintain the nest egg as time goes on and not over distribute if the market returns over the long term don't support it.
By the way, all the charts I've been showing come from Seeking Alpha, and I am a Seeking Alpha affiliate. Personally, use Seeking Alpha every day, not just for getting updates on the market, but also for research on the many alternative ETFs that I cover. So if you are looking for a stock and ETF research tool, consider Seeking Alpha and check out the links below for discount offers. And this is a great day to be talking to you. This is Wednesday for people that are watching, and we expect rate cuts around 2 p.m. today. And then tonight after we close, we have this Microsoft earnings, we got Alphabet earnings, we got Meta earnings. That represents about 18% of the NASDAQ. So for your products, because we're using zero DTE options, I think about this as the positive here is there's no overnight exposure, right? So if those three cause the market to rip higher, you get the benefit before setting your call options for the day, right? Tomorrow morning. And maybe the negative side of that is you don't necessarily get to capture that extra volatility. The kicker that comes along with those longer expirations that kind of bridge those earnings reports. So how do you look at that, and how do you position on a day like today?
Yeah, it's such an important question. So when I was first building the product, do I use 30-day? Do I use 0-day? And we did the math and we did the scenario planning. And the engineer nerd in me was like, well, if I can do 0 day, like just the precision that I can have to manage risk is so much better. Because if I wanted to avoid, for example, Fed meetings and I was doing a 30 day, like I would lose the whole month because I couldn't trade it. But with 0 day, I can be really precise. So we put options on every day this week. And then today, we don't have a trade on right now. And we're going to wait until after the meeting and the press conference because no one knows, one, what the Fed's going to say, but two, what the market reaction is going to be. And if the market reaction is like fervent, bullish, and super excited and it rips, and I'm stuck at a committed position after that, I could be in trouble with that day's kind of position. So that's why we kind of wait. We don't guess. And then after the market sort of starts to digest it, then we can put a position on. And that's where we harvest a little extra volatility. Further, to your point, big earnings after hours today. One of the tools that we use on normal, like no event days, are overnight rolls. If we get behind the eight ball in a position, we can actually, diagonally roll. So we add a day and then sometimes we'll add headroom to the strike. But on days where there's what we call tier one events, tonight is one, we don't have the ability to roll. We just don't do it because of the risk of if you have an option position on and it rips, you could get really behind. So that flexibility that 0DTE affords is really powerful. And two things to your point about like, okay, how does a 30-day kind of collect that extra volatility? The downside of getting caught behind if there's a big upward movement far outweighs any volatility that you can collect in that period of time. And the second thing is the option premium potential on 0 day. So the example I gave is if you did one 30-day position, call it 25 delta, and you collected X dollars in premium, if you did the same risk, so 25 delta every day over the 22 trading days over that month and added it up, you have 4 to 4.5 times the option premium. So that alone gives you a better risk adjusted return profile versus actually trying to catch the overnight volatility that you might get in the market. So that's why in upward moving markets, 0DTE, I believe, has a much higher probability to be able to keep up with, and in some cases, potentially outpace the market. And you can see that if you look at some 30-day strategies and you compare it to 0 day strategies from April 11th to today, where we've had this basically steady bull run. It's really hard for those 30-day strategies to keep up. And those are the reasons why.
For an investor out there that's trying to decide between maybe TDAQ, brand new fund, and maybe JEPQ from JP Morgan, like a well-known household name. The question that I get a lot of times has to do with the security of investing in an ETF, a new ETF provider versus somebody that's been around forever. So I guess, should this be a concern for investors out there as they're trying to deploy their dollars? Or is a RIC, a registered investment company, regulated to the point where this should not matter?
Should it be a concern? Of course, because it's your hard-earned capital to make sure that the team and the organization that you're putting it in has staying power. But the question that I also get asked that's related is like, what happens if Si gets hit by a bus or he gets sick? Do you have processes in place to make sure the fund can still run as it would otherwise? And I'll start with the example of why the answer is absolutely yes. In May of this year, we had our second baby, and I took paternity leave for 2 weeks. And we have the processes in place where there's a full team. So there's two of us within W-2s, but our hiring strategies outsource everything that's not core to the business. There's 30 people beyond us that help run the fund. People from Tuttle Capital Management, Goldman Sachs, Practice, Cohen, like there's these big organizations, US Bank is our custodian, and all of them have oversight into our processes, and we have redundancy for every single role. So on the trading side, Tuttle has, I think, 4 traders. We have a backup here. And so when I was out, they all covered down on making sure that we're executing the trades within the rules and the philosophy of the fund. So yes, it's a valid concern. And yes, you need to validate that the firms that you're investing in have the proper redundancies in place. But a 40 Act company is highly regulated. There's a lot of eyeballs on it, and that's kind of the coolest part. That's what I love the most, is because it's like super transparent, and that's what we're all about, so that people know when they're investing their hard-earned funds that you can see what you see is what you get. And so to the other question of like, do I invest in a big brand like JP Morgan or Goldman Sachs? Think of it like, you know, think of it like people are leaving cable for Netflix, right? Netflix started at zero, cable's been there forever, but you don't necessarily get the same level of innovation when there's a process and a revenue stream that exists that they don't want to cannibalize. But we have the luxury of starting from zero and can try things and do things that bigger organizations can't. And I mean, you can see it in the performance based on what we've been able to deliver, some of the edge that you get when you can be a little bit more nimble and a little smaller and a little more innovative. So again, it really just depends on it comes down to the people who like are super like structurally risk averse, and they're like the extra upside, but look at the charts and see if it's worth it. The extra upside of owning a TSPY or a TDAQ isn't worth it to me, so I'm going to put it in JP Morgan. That's good because it fits your risk profile. But if you're like, wait a minute, this upside plus all the stuff that we just talked about for redundancy process and a 40 Act product, this actually makes a lot of sense because of what we're able to get. That those are the people that would be attracted to products like TSPY and TDAQ, and I can speak to it myself. Like we were, I mean, all of my investable assets are in TSPY and TDAQ, and part of the reason I built this was because there was no product on the market that did what these two things did, and so you've got to start from somewhere. And we started at zero, and now we're at I think 120 million in a little over a year. So you're seeing that for a lot of people, it's worth that calculus to say, yeah, this is innovative. I'm seeing the transparency and I understand the philosophy because of the ability to dig into what the fund does through conversations like this. And they're making the moves from the bigger funds that have been out for 3-4 years that have been like the lead
Right.
blockers and created the interest. But there's going
Yeah.
to be evolution and innovation that naturally happens, and we're happy to be sort of a part of that process.
Now, as far as game plan for TappAlpha, I think you've had a game plan in your head. It was TSPY, and I think you told me if when I get to 50 million of AUM in that fund, I'll start looking at TDAQ. So that's been planned out for a while. But going forward, are you going to continue this process? Are you looking at some other products as well?
Yeah, so this is actually the coolest part. Like, well, okay, I take it back. I'm more of like a white space guy. I love to go on like a blank page and like put scaffolding up and create kind of something from like the world is your oyster. And then this is my second favorite part, which is the scaling now. So we've got a product and a model that works, and it's been delivering as designed over the past year, and now we're starting to scale it out with TDAC. So now we're trying to be really strategic about who we are, the people we want to serve, and what are the best follow-on capabilities and products that we can now add to provide value at scale. So we are very like we love the inbound emails and the feedback, like stuff that is important to investors, a lot of the subscribers on this channel especially. And so a couple of things that we heard were like 14%, 17% yields are good, but I'm kind of tempted by higher yielding products over here. The trade-off is the NAV kind of maintenance is challenged. The more you distribute, if you don't reinvest, that NAV could shrink. One of the things that can help solve for that over the long term, and it really depends on two things: your timeline and your philosophy about markets. If you think over time the S&P and the Nasdaq are going to go up 10 years, 15 years, a little bit of light leverage could be a benefit, because you'll be able to sort of get a little lift on what you're doing on both the capital appreciation and the distributions. So that's one thing we're exploring now, is a light leverage version of some of the funds that we currently have. The second thing that we've heard a lot of is that retail and DIY investors like more frequent distributions. So we're doing monthlies on TSPY and TDAQ, but exploring maybe a combination of a light leverage plus weekly distribution product that's targeted for the retail audience that wants both of those things. They want higher distributions. They're in it for the long term, but they want sort of more frequent payouts. That's one of the things I think from a product development standpoint makes sense to come to market with as a next phase. And the last thing I'll say, because I get excited about these things, but the milestones aren't the things that really matter. Like, yay, 120 million, it's a number in a spreadsheet. But what really matters are the relationships, the people we've met through the process and the support that you get and the feedback. That's the thing that creates something that's going to last a lifetime. So that's where we are now. This has been an unbelievably rewarding experience, challenging, but we're super excited to be part of this new industry and sort of building a brand, and most importantly, building a community and a network of people that are motivated and have the same kind of core values as we do as a business. And those are the products and those are the people that we're trying to serve with the products that we build. So it's been amazing. Excited for the next chapter. And one of the relationships I'm really excited to have too is with you and getting to know you, and excited to see what's next in your journey, because it sounds like there's some exciting things on the horizon.
Yep, that's right. The Dave ETF.
That's
We'll mention
right.
it.
DAVE. Reserve it now.
Yeah, that's awesome, and I appreciate all of your insights, and yeah, I love that passion that comes across when we talk. So appreciate all that. But thanks, congratulations on all your success so far, and keep it going. And I'm sure we'll talk again real soon.
Look forward to it. Thanks for having me, Dave.
So it's nice to catch up with Sign here about his latest ETF, TDAQ. Let me know what you think about this one down below. Like and subscribe if you like this type of content. If you want some more, you can go check out one of these videos next. There's plenty with Sai as well. If you're curious about TSPY, I'll link that one right up here. Put something else down here. Have a great night. Thanks for watching. See ya.